Hello, everyone, and welcome to SCORE Fairfield County's live webinar on making more money with your pricing strategy. I'm Tim Ryan, the webinar coordinator and a business mentor here at SCORE Fairfield County, and I'll be your host. Our presenter today is Sharon McNeal. More on Sharon in just a minute. First, some brief information on SCORE. Nationwide, there's over 320 offices with 11,000 volunteers. We're part of the SBA. SCORE Fairfield County has over 130 volunteers with a wide range of industry, process, and subject matter expertise. We offer 3 primary value-added services to small business owners. 1, free one-on-one counseling, mostly via Zoom these days, which can Number 2 is the educational workshops and webinars, over 150 per year. And number 3, we have extensive resources on our website, including a network of subject matter experts at your disposal, as well as templates to create business plans, etc. SCORE puts on scores of webinars each month. Look for future events on our webinar calendar at fairfieldcounty.score.org. Some useful information about today's event. If you have a question, please use the chat window at any time during the presentation. It is located in the lower part of your screen. Our webinar will end at 1 p.m. to respect your time. The session is being recorded, and the link to the recording will be available at fairfieldcounty.score.org within the next couple days under the heading of Webinars on Demand. Now, our speaker. Sharon McNeal has been a QuickBooks Pro advisor since 2002 and founder of McNeal Enterprises, LLC, a small business dedicated to improving small businesses' financial literacy. Welcome, Sharon. It's all yours now. Sharon, I think you have to unmute yourself.
Did I just unmute myself?
Yes, you're good to go.
There's more than one button to do this. Anyway, good afternoon and welcome to the webinar this afternoon. We're going to talk about pricing and some new strategies in pricing that have happened over the last several years to help you make decisions and give you some new thinking skills when you're planning on how to price your customers as part of your business. So let's start at the beginning. Next slide. Okay, so here we go this way. All right, that's you. Okay. The primary method we'll be talking about today is something called value pricing. Value pricing is a different way of engaging the customer in terms of putting together a set of work that defines an outcome that the customer wants and needs. The most important part of value pricing is that the customer is an active participant in setting the price. There is a process to set the price. There's a list of things to do, and the customer has the right, makes a series of choices during this session. The second thing that is very important is the customer knows the total cost of the engagement before the work begins. That is a very different situation now from most businesses in the professional service area. Next, the customer defines value in his own terms. The customer is the one who determines if the list of services and activities will bring him to, in his opinion, will bring him to hire you in order to fix a problem of sorts that he's certainly struggling with. Customers, another issue is that two different customers can have the same price, or multiple customers can have different prices. And this is true because each customer has a voice in how in how the price is built up over time, so that since the customer is very active in this, this gives the provider the right to bill in advance of performing the work. And this is very important to anyone who has chased down somebody who is not who's not paying them. This can be a bit annoying. I started using value pricing because I am a controller. There's a problem with this because most people have no idea what a controller is. So part of my prospecting work includes an education process. The simplest way to think of a controller is a controller would supervise a bookkeeper and would report to a financial officer. There are no requirements or licensing for a controller. I asked various people in the financial industry what that was before I started doing it, and the answer was, you just do whatever needs to be done. So in other words, there are sets of things that the set of things that a customer can ask a controller to do, but it is the exact engagement is negotiated in detail with the owner of the business. Another reason that I do this is that it gives me a competitive advantage. Other people who are in this industry, such as bookkeepers and accountants, they cost by the hour, they price by the hour, and having a fixed price gives me a competitive advantage. What is a price? A price is an engagement between a buyer and a seller. And in this situation, each person is acting under his own best interest. Neither party may know the full story of what's going on, but these two parties talk together and come to a conclusion about what is going to happen. So each one has an equal voice in the transaction, and the customer in particular has something, there's some pain point that needs to be resolved. That's the reason that he's hiring somebody to help, but it is not, that may not, it takes a while to get all of this out, but it might take a little coaxing along the way to find out exactly what that means. But the customer is very much in the loop with all of the beginning agreements and that sort of thing. So let's try this. How do most people set prices? I think I missed a slide. Okay. How do most people set prices? Typically, they make it up. When you're first, especially when you're first starting out, people have no idea what to charge. If you come out of a corporate environment, you had a rate there, but that doesn't count for that. That rate isn't your full pay because you have holidays and you have vacations and all of those other things. So many people have a hard time understanding in terms of their own finances in a business. They have a hard time understanding how much money they need to charge. So they simply make something up. And if it works, if somebody gets an engagement, that's fine. If not, they're trying to figure out what to do next. The most common way that people price is first of all, in the retail industry, there's always a price in front of everything. So you know exactly what the price is. But when you come into services that are from professionals, you don't always know the price up front. And that is because the work is very unique to the situation. And there really, there's really a lot of detail in there that would be mixed up in terms of an hourly rate and that sort of thing. So it gets a little very murky. The way that most people do it in the professional services area is they do a fixed hourly rate. And what that means is that if there's a team on the vendor side and the team has multiple people in it, they can have different pay rates for each hour that they charge in working for the customer. So that is part of the way, that is part of the price that will be presented to the customer at the end of the work. So it's a fixed hourly rate times the number of hours that the person engages in working for a particular customer. Then the next thing there is a number that covers the fixed expenses of the firm that is conducting the business. And that means that they have to pay their rent and they have to pay all those other things. So there is a cost part of this equation that will allow the company to stay in business. And that is the sum. They take the sum of those two numbers and then they add them up and take a percentage of the total, and that is their profit. There's a couple of issues with that, and one of them is that in a firm, there's pressure on the employees about how they hold down, how they enter their rates on the time card. So there are times when if somebody's not putting enough time in, there's a little bit of negotiation on the back end about exactly how many rates or how many hours are worked, are part of a specific engagement. Another thing people do outside of this fixed hourly rate issue is that they say whatever worked the last time I made a sale is good for this one. And this is another part of the guessing game. Everybody's happy. A lot of people hate it. The customers hate it because they need something very much. They need to solve a problem. They need to add a service or whatever, but they have no idea how much it will cost. The answer is we'll tell you how much it costs when we're done, because nobody knows how many billable hours are going to need to be billed before they can finish the job. The second issue is on the vendor side, there's a lot of technology advances, certainly in the last 5 to 10 years. And all of these advances are focused on being more efficient with your work. And that is not the best idea in the world for somebody who bills by the hour, because the more efficient you get, the less billable hours you have. And in addition to that, if you put together an application or some sort of a business process to make things more efficient, then you have to train your staff on how to do it. You have to pay for the technology, and still you're ending up charging less money. You end up getting less money from your customers. Scope creep is a problem that happens in the cost plus fee work because it is hourly. And so there's a suggestion about the work to be done at the beginning, but that can creep along and include additional work that wasn't negotiated early on. That may be okay if the company is really desperate for work. If there are multiple, if the organization if the organization delivering the service has a set of workers or employees that are able to do the work, they are responsible for booking these workers in terms of keeping them busy on customers. And so when somebody does scope creep and suddenly adds a new little problem to be entered, and the boss thought that the job was done, there can be a problem because they might need that employee on another job. So the next question everybody says is, how do I scale? The way that people scale in a cost plus fixed fee environment is that they scale by making people, by doing overtime. That can be a bit risky because if you come, that only works for a little while, because sooner or later you're going to run out of overtime, and then you have to think about hiring an employee, which is a very big business decision because that puts you on the hot spot for making payroll and that sort of thing. And a company really needs to have a solid book of business to add an employee. So the next question that comes up is, how much do you charge? And that's something everybody wants to know and nobody will tell. So if somebody says, well, let's ask the customer. The customer doesn't have a clue, and it's nothing against the customer, because what is happening is that the customer is engaging somebody for a service that isn't part of the things that they understand or do in their business. So it's an outside skill. It's something they really don't know. And they many times don't have an understanding of what the price ranges are in a different industry. So somebody says, let's use the street price. The street price is the market price. It's the price that people talk about, when they're having a beer at the end of the day or whatever. And that price is yesterday's price. It may or may not be valid now. It could be an old idea. Somebody could be exaggerating when they're talking about how much they price, etc. It's an unknown. Suppose that you in your business have an idea for something that you think is going to sell and make a lot of money for you. Once you have a new idea, if it's a new idea, nobody else knows what the price should be. How do you figure that out? There's nobody else. It's new. So what you do is you do your diligence and you talk to your current customers and say, I have this great new idea. Is this something that interested you? In other words, I just want your opinion. I'm not making a sale out of you. I just want to know what you think. So you go through your due diligence and you say, you know what, this is going to work. I think this is really going to work. I've got enough diligence here to think it's going to happen. But then you say, how much do I price it? And that's something that's a very difficult question because you're in new territory. Another way to price is to price below your competitor. So what you say is, I'm going to drop 10 to 20% from what my competitor does. Well, that's a really great thing for you, because that means in order to earn the money that you needed before, you need to work 10 to 20 times more hours than you had before, because you're dropping that rate. When you drop your rate, you drop your income. So that puts people in a bind when they have what we call it is the race to the bottom. There's a lot of work at the bottom because they don't charge very much. Then there's other special deals that happen from time to time, like vouchers and specials, and something like a special for 3 months or whatever. These are small. These are used for situations that are ongoing work, and such things as vouchers and specials work early on, but soon the customer is going to see a price go up because they're for a short-term situation. So what is fixed pricing? Fixed pricing has certain requirements. And the first of the major requirements is that you need a very specific list of services or outcomes that you are going to deliver to a customer. And you need to understand this, that both the customer and the supplier need to understand this in great detail. Because when you have a fixed price, everything that happens under that price has to be on this list of outcomes and services that are negotiated in advance. If something happens and they need more service, you go back to the table and make an adjustment to the fixed price going forward. And the same would go through if it turns out to be less work than people thought would be required. Another noticeable part of fixed pricing is that we give people a choice. And since we're talking about pricing, a big part of this choice is that there are 3 different prices. There are 3 different lists of services, and it's a level of service for each one of the choices. And the customer will choose one of those levels of service. But there is a lot of that. Sorry about that. There is a situation that didn't work. Sorry. There is when the choice comes up, when the customer sees the price, they see all 3 prices at the same time. At that stage of the game, And there's a question, is this okay with you? Are you have any problem with this price? And if the customer says, I'm okay with this, the next step is to do something called an upsell. The way that I think of an upsell is if you go to McDonald's and you say, supersize me, that is an upsell. An upsell is an addition to a known price that would enhance or add more service to an existing price. And this is like an individual feature that you would use. We're no longer in the area of a level of service. This is a service that is possibly an enhancement to the price that they've already discussed. Once there's a list of these for each one of the three choices, not if somebody chooses the lowest choice, they don't get the chance to have an upsell that's in the higher priced option. Once those choices are made, there is a review of the payment options and terms, and at that time they both reach an agreement. There's a discussion of the exact terms and conditions and guarantees and any other thing that would be a written agreement, anything that would solidify this price. Those are the major steps of fixed pricing. What's all this stuff about three options? The answer is really simple. It works. Go to Starbucks, and one of the things that is really interesting is to park yourself in Starbucks and to watch the banner in the back that has the three different options in it. The price for those options is underneath the item, the picture, so you can see what each one of them does. And what they're doing is that they're charging for different amounts of coffee. So what you have in the coffee is they say, for some reason they call the smallest one tall, which has always amused me, but they have their own names. You say, I want a tall, a venti, or a grande, whatever, and they prepare it. Now notice that this is the three options for them, but you can also say, I want 2 extra pumps of caffeine in there. So that would be the upsell in Starbucks. And then you pay your price and you go on your way or stay in there. And I don't know if you can still stay in Starbucks right now or not, but anyway, that's the situation. The Apple iPad was not released all at one time, but here is another set of 3 choices. The Shuffle, which was the first one, I thought it had to do with people working on a treadmill, and that's not what it means. A shuffle was that you pulled out your iPad and said, started it up, and you got whatever music presented itself. You couldn't play the same music twice in a row, but you could just play anything, and you were just listening to music for no other purpose than a background. The Mini is the second tier level of service, and in that case, there was a small screen on there where a person could change pick the next song that they wanted to hear. And finally, the Classic had a lot more memory, and they could have basically a music library that they carried around with them. So those are 2 examples of the 3 levels of service. One of them has to do with the amount of coffee that you're going to drink, and the other one is, what are your choices? How many different choices that you have for your own entertainment? So the 3 options are the different levels of service. And of course, there is a different price for each one of these. And obviously the one with the greatest options or whatever is the highest priced option. And the prospect chooses which one they want. So this has been around. This whole notion has been around for quite a while. Now, how does this help us understand pricing? The first issue is that there is no such thing as a single price for all customers who want to buy the same thing. The reason is no matter what the price is, you're guessing, and it's always the wrong price. You don't know if the customer is willing to pay more, or you don't know if the customer is paying too little. You're not really gaining information by giving somebody a price. The only way to price is to test. And there is, and this is something that's really, when you're especially starting out, this is a really tough thing to do. The way that you test is you write it down. You say, "Dear diary, I tried to sell my widget today for $100 and I got turned down." And you write a little note. And then the next time you say, "I tried to sell my widget today for $95. And that way, you know, when you're not gaining the business, you know what prices are not working. And eventually you come into the place where somebody actually buys your stuff. And then once you buy it, there's another process to understand what all that means. If your lead to closure ratio is high, that means that most of the time you talk to somebody, they buy. That means you're probably too low and you need to raise your prices. If you lose all the business that you're with your prospects, then you're charging too much. So if your lead to closure, if you sell too much, you need to raise your price. If you're selling not enough, you need to lower it. This is the process of testing so that you can understand more about the prices that are working in your area and with the type of customers that you have. This in the long run is very frustrating to begin with, but this is the way you test the market. This is a very important part of business, is testing the market. The key points in value pricing is that the customers don't buy time. They buy results. They buy outcomes. They have a need. They have a pain. They want something that addresses that situation. The customers also want certainty. They want to know what they're going to get and how much it's going to cost. And that is what fixed pricing answers. They've had a choice. They know exactly what it's going to cost when they're done. The other part that's very important is that each customer has its own expectations, and the person who is selling the outcome is not necessarily know what the customer really wants. After dealing with this for several years, I came to a new definition of business that this is part of my ethics on the way that I work. A business exists to generate wealth outside of itself. When I have an engagement with a prospect or a customer, I tell them my job is to increase your wealth. That is my goal. I want to do that. And I might need a little help from you from time to time, but my goal is to increase your wealth. That usually startles them a bit, to say the least. The realities of fixed pricing are that it's hard. It takes time. It takes patience to do this. The issue here has to do a lot with the pricing systems that are part of a well-run business. Fixed pricing assumes that you will know how much it costs for you to offer a service and to deploy a service. This means that things have to be under control. You need a good relationship with your vendors. You need to have your service delivery has to be the same each time. The fixed price rests on a system of good business processes that go well together. Because when you have a fixed price, the risk is on the provider. Because if the outcome does not happen and there's a problem in the situation, then there's no charge because there's no outcome. In the situation where you have the cost plus fee for a hourly pricing system, the problem, the outcome, or the, how do I say it? The risk is associated with the customer because the customer has no way of knowing what is going on, no way of knowing how much money they're going to have to pay. In the end, they get this big bill at the end and they don't, and it's a shock. They usually don't know what it is. In some situations, it's very difficult. Suppose that you engage a lawyer and the lawyer can't tell you anything till it's done. That is the standard in a lot of the prices for professional services. In value pricing, there is a risk, and that means that you need to have your business in good shape. You need to know what you're doing. You need to have a good relationship with your customers and your vendors and your team, et cetera, et cetera. So this works when you build a business and you tend to business. Okay, it looks to me like I am a bit ahead of time, I'm thinking here. What this is a list of, how do we say, this is a sample of a fixed price agreement. This sample is associated with my controller offerings. Most people don't know what it is. And so one of the issues with fixed pricing is that you need to communicate to the customer what it means to them. It's not what you call something inside of your business. It's not how you talk with each other inside of your business. You have to say something that has meaning to your customer. So in this case, I divided the list of offerings. These are 3 bundles, and the services in the list are all separated. If you notice here, the most expensive one is on the left, and then as you go to the right, it is less expensive, but there's less service. So in terms of an offering, there are the person who is on the one-time fee is paying a lower price. And when we look at the lower price, there's a lot of technical words for this, but I have to explain to somebody what a file integrity check is. And the customer needs to understand this because it is a fixed price. And I'm going to be held for deploying that. The other 2 have the same issue with respect to the services. And you'll notice that the service on the left is the most expensive service, but it has the most possible outcomes for the customer. There's other things that work here. I put them in different patterns with ticks and crosses, so it's very easy to see what is going on in terms of the service. You know where most of the service is. In terms of what situation it is. For example, one of the things that happens in businesses is that they do not monitor. There's certain expenses that are very critical, and sometimes they don't have any expenses, so they might want the lower level. Or if they have some key expenses that they want a controller to watch or help negotiate price changes, then that would be the higher end. At the top, you see the number 12, 6, and 1. In this case, this is for a service that is a year-long service. In this case, this is a service for each year. So what happens is the customer can pay the price. They can pay it once a month, they can pay it every other month, or they can pay it once for the entire engagement. When they pay it once, it's for the entire service for the year. And that is the only money that exchanges hands during that year. The other issues here are associated with the different options, the different purposes that the customer would want to engage me. If they're putting something together like a new business, it's a foundation situation. And there are things in here that happen when you're just starting a business, but the more complicated things are missing. If they ask for the middle course, they have additional services that they need. And this would be the level of service. And then there's an upsell on this, but the price, those are called the terms and conditions of the price. And in this case, they would be paying it in advance. In other words, they would pay a month in advance, or every 2 months in advance, or for the one-time fee, they would pay the whole fee at one time. This is a value pricing, and I'm the one that's taking the risk. And so I deserve to get paid at the time of signing the agreement. So the customer knows exactly what's happening. Part of this that is that's cut off at the top is one of the major issues in fixed pricing, and that is that you need to understand the market where you're selling your offerings and services. This really talks about the level, the types of service that you need to know it well enough to know what will sell. So for example, I have in my head, I have a fictional customer in my head, and let's just call her Alice. So if Alice is just starting a business, has certain needs for that, I say above this where the price is, I will say this option is for a very small business or a new business or somebody who just wants the basics. So in my area where I can go out and look for customers, there are people who have that situation. They simply want the most basic thing that they need to keep the business running. There's another group of people who need to have certain things like monitoring sales tax or having a different, and what's an asset register has to do with, with handling depreciation and that sort of thing. That is a mid-level customer who needs additional services, and they probably want a budget, and they might need to track if they're doing their job as a good business owner, they do have a budget. The lower price for Alice is just trying to get going. There may be a budget, there may be a financial one with some goals, but I'm not the monitoring there, the details of that. They just have something at a very, very basic level. When you get down into the middle and higher prices, then I have discussions with them once a month about their budgets and how things are working, how things are getting set up to go to the accountant and that sort of thing. So those are different levels of service. So the highest level service is for somebody who wants the very best help that they can get in order to make their business grow. So this person has a different set of, they have a different set of services because they have different goals. Part of putting together a value price engagement is to understand what the customer is really trying to do. And so what I have names for that, sometimes I have different names for movie stars, and sometimes in my own head, I do animals, but I say diamond, gold, and silver on a general case. But I have 3 distinct types of prospects within my area where I prospect. So I can say to somebody, I know I'm looking for somebody who's just getting started and wants to make sure that they're setting things up right. I know that that type of customer exists, and I can ask for that in elite exchange groups or whatever. I can explain what this customer looks like. And if I'm asking for a referral from one of my customers, I can say, I want a customer like you who wants to have the very best service at all. I would appreciate a recommendation. So you have a description of who these people are. So you're not trying to sell icicles to Eskimos or something like that. This is very focused. These are very focused outcomes and offerings, and they are meant for very specific types of very specific ideal customer to work for. And when I put this list together, I had to stop and think exactly what would they want. Because if I want somebody, if I put down there under the lowest rating that I'm going to help somebody put together the way that their invoices look and make them pretty, the Alice over here does not care about that. Alice just wants the invoice to come in. This is more important to somebody that is a more mature company, a larger company, and are at a different level in the life of their business. The holistic system down at the bottom means that the things that I have talked about being part of value pricing are present. In other words, the business is acting, the business is able to produce my business is able to produce this outcome, and I know that I have offerings that will actually be there for each one of these services. I have the vendors lined up. I have backups in case somebody doesn't do things right. All that stuff is put together. This is a system. It is not pulling a price out of the air.
Sharon, you have a couple good questions that have come in.
Okay,
one
sure.
of them is asking, looking at your table, how do you find or understand what has meaning to the customer? Or how do you translate your language into the customer's language, I guess?
The customer's language, that's a very, very good question. What goes with this, and I didn't put this together, is I have a brochure that explains this in the terms that the customer would understand. In other words, so there is an additional document that goes with it. It's a brochure. It's maybe like 12 pages or something. And the prospect will take that away and say, what does it mean to monitor expense services? And in that brochure, it will say that they keep track of the prices that the vendors have. And if there's an issue with an increase in price or an increase in service, that would be part of my job to help the owner work their way through that. So it's a good question. There's an additional document because it's a very good question because everybody really needs to understand exactly what's happening.
Right. So are you implying that you don't necessarily give this sheet to all customers? You would actually tailor the sheet. So if you had a customer, a potential customer that, for instance, is not sales taxable, you wouldn't even have that line on the sheet? Or would you leave it on, I guess? Well,
it depends on what they want. If they don't have sales taxes and they want the best, if this is heaven for us before I say it. They have a really good business that makes money and they're not paying taxes. So that would be nice. Sales tax, that would be very nice. So what I would do at the end is I would make an adjustment in the price and drop that the cost that I've attributed to providing that service.
Right.
I would drop it in the final as we go through this, because it's really very important not to charge somebody for something they're not going to get.
Right. So someone else was asking, how do you address mission creep?
The way that you address mission creep is there's a set of questions in the early stages of the work that says, like, if you're a web developer, you're going to say, my price includes three drafts, And then at the bottom, you would say as an upsell, there would be a different price for every additional layout that they want to see. So it's covered. That's a big price, a big issue with web developers, because people want to say, I know it when I see it, but there's a lot of work on the web developer side.
Right. And
So-
Mayo says they're a geophysicist. I don't know what that is, actually. I acquire information, process, and deliver the results. So how would they apply that to, I guess, that type of business?
I believe I think it's an engineering business. By the way, I have a background in engineering. So basically what would happen is that we would take a look at their services, and we would segment take their services and segment it into a different number of potential target, how do I say it, levels of service. And we would proceed with that. And there's a, a process that goes with this. This is built, the question that, just to give you some background, this chart is only for controllership. I have another chart, which I'll show you in a few minutes, which is for payroll. And the difference here with controllership, as I said, there really are no legal issues about what has to be on what list. When you go to payroll, there are statutory services that have to be done with payroll. So that's a different process.
Great. I'm going to let you continue on now. There just seemed to be a lot of interest on this schedule. Thank you.
Yeah. Okay. I thought this would be very. I think it's easier to understand when you see the layout. But the other answer is, for every service I offer, I have one of these. This is called a one sheet. Okay, this is the payroll. And the reason that I added a second one in is that in the payroll, this can be tough. This absolutely has to be done. So when we look, these are the three levels of service. And this level of service has to do with a variety of needs, because it's very broad. There's a level of service that has some statutory issues, and then there's a lot of issues with respect to upselling and cross-selling on this. So the first thing is, and some of this, a lot of people don't know what this is. I worked with an Englishman when I started this, and he was talking about how they did it in London, and I was terribly confused. So what I did is I'm a partner at ADP and reseller at ADP, and I had some help. That's the bottom line. The essential payroll over on the right is basically the statutory requirements for running payroll. In other words, you have to process the payroll. You have to submit the payments to the IRS. They want their money right away. Then you have to submit to the state, and then you have to actually put the money in the bank account for your employees. And then at the end of the year, there's W-2. All of this is statutory. This absolutely has to be done. It is not negotiable. All right. Now, in the other area down at the bottom, there are other matters. For example, the issue of a payroll activity calendar is a big deal, because some companies have multiple payroll cycles. And so under the statutory area, that's not part of the statutory area, that you can have multiple payrolls. This is one payroll under the this is one payroll that's for the company in the essential payroll, but there's other things you can do. So for example, down on the bottom, you say court ordered garnishments. This is extra money that has to be pulled from an employee and sent to some marshal somewhere because they've got child care payments or whatever. Okay, so this looks kind of technical, but this is basically the language of payroll, and the brochure that goes with it explains what this is, what it really means. Now, let me just flip to the next page. This is another reason I put it on. This one has a cross-sell at the top. So if we go to the first one, let me go back here. Whoops, I went the wrong way. Oh dear, how did I do that? How do I get back to this, Tim? Okay, how do I go backwards? Let me try this again.
We are getting low on time, Sharon, anyways. We want to
Okay,
leave a little bit of time in case people had questions.
Other questions, I really apologize. I hit the wrong button here. So how do I go back?
No, that's fine. In fact, you can go to the last slide.
Okay. Good.
Wanted to thank you very much.
Oh, there it is. I rolled it. Sorry for
Right.
it. Okay, just down at the bottom here, this is something that's very important. I'm sorry about running over the time, but what's happening down here is that because I work with ADP, I can help them with retirement and medical care and all those other things that are offered. These are called cross-sells. This is a totally different issue. And these are priced based on how many kids the guy has at home and that sort of thing. So this is a really good definition of a cross-sell. Okay.
Great. Well, thank you very much. We're going to take as many questions as we can up until 1 o'clock. So please submit them via the chat feature at the lower portion of your screen. And Sharon, this was great. You're using your own business to demonstrate the 3 choices. Really hit home when you gave the Apple and the other examples.
The iPod, yeah.
Terrific. We had one question here on BOGO. Please explain what you think the pros and cons are of BOGO's buy one, get one free, and giving a service for free with the product you purchase. And I guess to me, I'm thinking of Town Fair Tire, where they'll sell you a tire, but they'll also give you free tire rotations for the life of your purchase. What do you think of those?
Okay, I'm not trying to be vague, but the answer is, what is your purpose for doing this? If you're selling a new brand of tire that you've never had before, there might be a special to bring it in so people could understand what it is. There might be, you might be out of inventory towards the end of the year, and you might want to get stuff out so you don't have to mess up your taxes. It depends on the reason that you're doing this. And the issue is these would be short-term adjustments to handle a situation. So like I said, I'm not trying to be vague about this, but then there's another thing that that my phone service did to me. And this is actually a pricing tactic. And what they did is when I signed up, they said, oh, you have this really great deal, blah, blah, blah. You're going to pay X amount of dollars, yankety, yankety, yam. So then I start paying that. I get used to paying that. And then the thing they didn't tell me is that that price was only good for the first year. And so by that time I'm using it, and I thought, wait a minute, what happened? I didn't do that. And I called them back up and they said, oh no, you were on a special deal. You had a lower price service to begin with. And then we increased the price over time. This is one way of gaining business. And the answer to that could be because the prices go up anyway over time.
Right.
And there has to be an allowance for that. So
yep.
It's your purpose. You have to know what you're doing.
And Ed is asking, what are the best ways to know which pricing method works best for a potential customer?
You have the issue is that you really have to listen. The biggest skill here, I tell people, listen, the good Lord gave you 2 eyes, 2 ears, and 1 mouth. You have to listen to the prospect, and you have to, if they talk about pain, you write down what they're saying. You have to listen so that you can communicate with them. So I'm not really trying to be vague. The key there is the communication that you have in terms of when you're prospecting.
Right. And there was another question. You started out talking value pricing and then fixed pricing. Are they the same thing, or is one a subset of the other? What's the relationship between those?
Value pricing is the general case, and menu pricing is what I talked about. So let me give you an example of strict value pricing. I don't think this will take too long, but it's informative. I have one of my customers is in the trades, and he has all these trucks. And his bookkeeper left the state, and he wanted somebody else, so I took over his books. And about the second year, I said, "You have all these trucks here, and I don't see them on your balance sheet." And he says, "Well, they're all paid for." And I said, "Okay." So I looked at him square in the eye, and I said, "Here's the deal." I said, I'm going to see if I can get you a refund on your income taxes. And if I can do that, I want the first $1,000 of the refund you get. And the guy was happy because he'd never had a refund in his life. And so I said, I want you to go up and get your original paperwork for all those trucks. And I'm going to put a spreadsheet on them and give them to your accountant. And he did, and I did. So this is, the man thought he wasn't going to have to pay me a dime because he never had gotten a refund in his life. And so here he comes and he hands me this big fat check for $1,000. And he was very happy. And he says, I got more of these in my pocket. Thank you very much. That is value pricing. In other words, I had an idea. There was no billable hours there or anything. I had an idea and it was worth money to him. That is real value pricing. My idea had value.
Right. Got it. Okay. As a reminder, a recording of this webinar is available within a couple of days on the fairfieldcounty.score.org website. Please check out our website for information on upcoming webinars. Again, SCORE offers free individual counseling, so please use the link on the screen, which is the last page, Sharon, if you want to go to that.
Okay.
We're available for sessions via phone, email, or Zoom video. Also, please fill out your evaluations that have been sent to you at the end of the webinar. On behalf of SCORE, I'd like to thank you all for attending today's live webinar. In closing today, a big thank you for the first-time speaker for SCORE, Sharon McNeal. Thanks, Sharon.
You're welcome, and thank all of you for your help. It's really, really great to work with you.